Good afternoon, everyone. It's great to be live back on LinkedIn. I'm really happy to be here because my wife has told me that she doesn't want to hear any advice from me at home. So, this is the only place I can come to share some gyan. On today's show, I'm really excited to invite Pratik Oswal. So, Pratik leads Motilal Oswal's mutual funds, passive funds business. This includes the very, very popular index funds and also ETFs, where he looks young, but he oversees assets worth over 15,000 crores of people's hard earned money. Pratik has studied math and economics at Emory University, and he has an MBA from LBS. And we're going to have a fantastic discussion with him. Pratik, welcome to the show.
Hi, Adil. Thanks for having me here and looking forward to the conversation.
Yeah, so Pratik, I think what struck me about you when we first started talking is, you have a deep intellectual, background where you've studied math and you've done an MBA and you're thinking about this subject, but you're also working in this business, handling a lot of investor money. What attracted me to index funds, right, is when I learned in graduate school that index funds offer the efficient frontier where the return you get is optimized for the risk you're willing to take. And that's what brought me my interest to index fund. What brought you to get interested in index funds?
Yeah. So when I was, I used to be a wealth manager in the U.S. In San Francisco, and I used to manage money for around 800, 900 sort of investors. All ultra HNI investors, and I saw that and I was exposed to their portfolios, the investment portfolios, and I saw that a large part of the portfolio was investing in index funds and ETFs. I saw that a large part of their portfolios were invested outside their home country, which is outside the US. And I also saw that a lot of their portfolios were invested in these, factor or quant funds. So when I came back to India in 2018, end of 2018, I did a like-to-like comparison about, what is it that India sort of will need, not now, but maybe in 10 years' time. And I saw that back in the day there were no really any index funds, ETFs. I mean, there were a few, but only available in the large cap domain. So that's how I sort of started the journey of, I think getting into index funds, ETFs. But honestly, what really motivates me about this category is the fact that if you look at wealth creation, and I what motivates me is to create wealth for all my investors. And wealth creation is increasingly complex in today's world. I mean, there's hundreds of funds out there, and I believe that and I keep telling this to investors, is that on your salary it's very hard to create wealth. You'll obviously lead to a better quality of life, maybe better lifestyle, but actually wealth creation happens during ownership. You have to own stuff. I think ownership is very important, whether it's real estate or equities or gold or whatever it is. I think good assets. And I think we all know from history that equity is the one asset class that gives you the highest returns. And within equities, I think mutual funds simplify equity investing, but then index funds simplify mutual fund investing. So I think one thing that I really think index funds are a good categories, because it's the easiest way of owning stocks. Is the easiest way of owning one of the asset classes which gives you the highest return over the long term. So I think that's a big motivator to why I think this category is very, very sort of interesting for me. And also I think I'm very lucky to be a part of a sort of mutual fund house that sort of prides in innovation. So I think that's also sort of helped us along the way.
Fantastic. That was great insight. So, Pratik, since you've seen this both in the US and India, my question is in the US, right? If my understanding is correct, a majority of investors come in via index funds, right? And in India, index funds are the fastest growing category, but still they are a minority. Is a day going to come, right, where you feel India and US are similar enough that the majority of money coming in is going to be index in India soon?
Yeah, I think it's already happening. If you look at the stats in India about, how big index funds are, and the stats are, quite staggering. If you look at 2016, 2017, index funds, ETFs were sub 10,000 crore category. Today, it's upwards of 7.5 lakh crore. That's almost maybe 75 times just in the last, say, maybe 7 to 8 years time. So I do think that yes, there is already a lot of traction happening in index funds, ETFs. Yes, a lot of it is coming from pension funds and sort of those sort of institutions, but we've also seen a lot of participation happening from retail investors. I think one of the biggest sort of challenges of, I wouldn't say challenges, but obstacles towards widespread sort of I think adoption of index funds is actually knowledge. Not many people know about what index funds are, what ETFs are. So I think that was a big, I would say, barrier about 3 or 4 years ago. But increasingly over the last few years, that's becoming less and less of a challenge. So I think education is very important. My job, my main, I would say, where I spend 40 to 50% of my time is just customer education, investor awareness. So I do believe that it will sort of exponentially grow. It already has sort of grown a lot in the last decade, and I believe that it will only grow from here with more and more investors coming in. I think index funds was an option. Today people are asking about, okay, how much should I allocate with index funds? Should I allocate 5%, 10%, 20%, 30%? So I think that is the conversation today, and so you are seeing a lot more adoption today than maybe you did a few years ago.
Got it. So 75% growth to 7.5 crores in index AUM. And a day is not far away because the trajectory is very clear, where index funds will be the largest category of mutual funds in India. Is that right?
Yeah, I think if you follow the US, then yes, you can expect index funds, ETFs, passive funds to be the largest category, in India. So yes, I think, I mean, I'm not sure when it'll happen, but most investors, most sort of asset managers expect this to happen over the next decade or so. So yeah, I think that's at least what people are expecting, and also you have to understand that the market has also grown a lot. So I think if you look at the US market, somebody was telling me that India right now is very small compared to where we are in terms of comparison to the US. Index funds is about 7.5 lakh crore, so you can expect this 7.5, the overall mutual fund AUM itself to grow by at least by at least 10 to 15 times over the next decade. So that itself is going to be, so overall I think you're looking at a huge expansion in the industry, which will again benefit everyone, including index funds, active, passive. There's going to be a lot of innovation in this space.
Got it, got it. Fans of managed funds will present some counter arguments. We'll get to that in a bit. But first, right, when I recommend mutual funds, index mutual funds in particular, even to my family members, right, I get the following questions, and I'm going to run this by you. So I'm reading from the Bank Bazaar book, The Bee, the Beetle, and the Money Bug. So it says that the price of the Nifty 50, right, um, since 1st January 2020, that's over 23 years, has had a 12% CAGR. So typically, when someone asks me, I say, okay, you can expect 12%, but obviously the future is not basis the past. But what should I tell people, right? What can they expect when they go into index funds?
Yeah, so I think the expectations are pretty much in very similar to what you would expect in the long term past. I think the India's growth trajectory, if you see, I think people are a lot more optimistic over the next 25 years than they were in the last 25 years. So I do believe that obviously it's hard to comment on what will going to happen, because obviously you have market cycles also, you have bull markets and your bear markets. But I think 12 to 15% is a good assumption for most investors who are looking at equity as a category, and index funds tend to be the equity itself. So I do believe that that's a reasonable assumption for anyone looking at investing in equity. Yes, investors who are looking at more than 12 to 15%, I think they should be warned that yes, that is something which I mean, it is difficult to outperform the index. So I would say then yes, it's possible, but I think 12 to 15% is a reasonable assumption for anyone who's looking to invest for the next few decades. And the best part about index funds is that unlike a lot of other funds, you may or may not get there, but index funds is the market return. So I think the probability of you getting there is much higher. And number two, if you're a young person looking at investing for the next 30 years, it's very hard for you to select one particular fund. The S&P 500 fund has been around since I think it was since the 1970s. So it's been almost half a century, and people are still invested in it. So I think it's really for anyone looking investing for a very long time. I think index funds become super easy, to sort of invest in.
Got it. So fair enough, right? I think 12% plus pre-tax, when you know that your long-term capital gains are 10%, is a handsome return if one can achieve it. I'm going to the second question here. So, in the book, right, the Bank Bazaar book, we say that over the 1 year period ending June 2021, the BSE beat in 85% of cases managed funds. I'm sure this can be done for any period, right? But my understanding is that the index fund typically tends to beat managed funds in a majority of cases all in. Can you just share your views on this?
Yeah, so I think there is obviously one reason to why index funds have been preferred in the at least the West is because they tend to be the best in terms of investment returns. So at least in the US, what we've seen is because that market is very efficient. What we've seen is the index funds tend to beat 85-90% of all other managed funds or actively managed funds, and that's one of the reasons to why you've seen a lot of inflows. In fact, if you look at the mutual fund industry in the US, there's approximately over 100% of incremental flows coming into index funds. So people are putting their money in index funds, and also you have people who are selling actively managed funds and putting into index funds. So that is the sort of I think growth that you've seen in the US in ETFs and index funds. I think in India also you've seen a similar statistic happening. I think Indian markets compared to say 10 years ago have become a lot more efficient. Someone was and the reason why the efficiency is high is because you have a lot more analysts covering the Indian market. So for example, just in the large cap space, the top 100 companies of India, which is where I would say majority of most investors tend to concentrate, you have about a couple of hundred analysts that a job is to and maybe a few thousand, maybe a few hundred or few thousand fund managers out there whose job is to pick the right stocks, buy the right stocks, sell the right stocks. So what that happens is that when you have so many people covering so few securities, it's very hard for someone to really pick the right stock or pick buy low, sell high, because most of the stocks are optimally priced. Which is why I think sort of being a stock picker, at least in the top 100 companies, has become a lot harder than it was say 10 years ago. So I think that's why index funds tend to be really sort of efficient, because they are officially funds which you can use to play the winners. When you buy an index funds, you're essentially, or a Nifty 50 index fund, you're essentially putting your money in the top 50 companies of India. And guess what? If the company does not perform, it's automatically removed from the index. And if a company does, it gets sort of upgraded. So it's a very Darwinism form of investing, where you're basically playing and you're surviving. You're basically playing with companies who survival and who are growing. In fact, what we've seen is that most people would agree that the top 50 companies today will be a lot bigger than the top 50 companies, whoever they are, in 10 years time, and that's what you're playing with the index fund. So I think that's one of the reasons to why I think you're seeing a lot of interest. But the biggest reason is at least for me personally, is not to do with performance. It's to do with simplicity. I think we believe that at least as an asset management house, is that index funds offer a lot more simplicity for investors who are looking at investing. I think yes, performance is there, but I think for someone who's looking at a mid cap fund, there's 40, 50, 60 options out there. But you could always just select the index fund, because the returns will be as good, your costs are very low, and we've seen from history that the performance is really good, almost at par with some of the best funds. So I think simplicity has become the main reason to why someone is adopting index funds. So we at Motilal Oswal actually recently concluded a survey with 2,000 of our own investors, and we realized that the number one reason to why all our investor base is selecting index fund actually is not to do with performance, it's to do with simplicity. So I think they really feel that index funds help do the job, and they can just invest in it for 10, 20, 30 years without really worrying about bad performance. And they can also expect low I think low costs, which obviously is a big draw for index funds.
Yeah, yeah. So, you bring up a really interesting point with the Motilal Oswal survey, that simplicity could be the other key driver, right? And, you put your money where your mouth is with 15,000 crores being managed under this strategy. Now, I'm a big proponent of index funds. So my daughter's savings, right, which whatever we can put aside is in index funds, not in any other instrument. It's plain and simple in index funds. In the Bank Bazaar book, we recommend index funds. But I think it's very important, right, to be able to deal with the tough questions that might come from people from other views, right? So I'm going to throw three of these tough questions at you. And I'm really, really curious, right, to learn from these answers. So the first one, right, and I'm sure you've heard this before, amongst Indian mid and small cap category active funds, right? In the period ending June 2021, over a 10-year period, the active funds had beaten their peer index in 60% of cases. Now, talk me through this, right? Because there is a belief that, hey, when it comes to small and mid cap, it's sort of different. Help me think through this.
Yeah, exactly. So I think it's a very good point you made. I talked about earlier in the that about the thing with efficiency. I talked about the fact that the top 100 companies are the widely or most watched companies. The analysts that are tracking every single step of the company, of the CEO, of the management, of its distribution and its business model. So stock picking is exceedingly hard when it comes to the top 100 companies. But as we go down the pecking order, say mid caps, small caps, micro caps, you are finding an environment where you can actually find first it's a source of growth. Just on the basis of size, you're looking at investing in companies that are growing much faster, but also you're looking at slightly more, it's an environment where you can do a lot more stock picking. And I think that's one of the reasons to why you're seeing a lot more outperformance happening in the mid and small caps, because obviously efficiency is relatively not as much as what you would see in large caps. But again, as I said, I think simplicity is something which I really feel investors should adopt, because I think yes, there is an equal opportunity for you to do better than the index, but I do believe that you really have to choose, I think which mid cap fund or mid small cap fund to do well. And honestly, that's not even the real reason to why I think investors should do active versus passive. So there's another very interesting study that is done in the US, and also we actually replicated it in India, where basically and I'll talk about the Indian study, and it really talks about what does the investor make. We all know what funds make, or how funds perform. Some fund has done 20%, some fund has done 15%, but we sort of took do this study where we asked the question, how much do investors ultimately make? And I think regardless of you invest in an active fund or a passive fund, we mentioned that in an index fund you'll make about say 12% pre-tax. That's a very healthy, reasonable assumption that you would make. But the reality is that if you look at investor data, investors on average made about 6.5 to 7% returns over the last decade. So that really means that investors. So it doesn't really matter if you're buying a good fund or a bad fund. I think the issue that we as investors, or as investors, need to sort of solve for is we make a lot of mistakes. We buy and sell funds. We buy at high fund, we cancel SIPs. So I think investor behavior is a lot more important than selection. I think the psychology of investing is a lot more important. So I do believe that investors who are looking at small and mid caps, regardless of an active or passive, I think that doesn't matter. Both will give you very good returns. But it's very important to not make mistakes such as stopping your SIPs, or mistakes such as investing in bull markets and not investing in bear markets. So I think those are one of the reasons to why investors do not even end up making even investment in index returns. So I think that's something which is a lot more important.
True, true. Well said. So the second question, right? So I was researching, preparing for this, and also for my own financial planning, and I'm not going to mention the exact brand name here, but there is a really well-known, well-performing 30,000 crore AUM value discovery fund, and as of today, right, the 5-year returns is a 16% CAGR, the 3-year returns is a 29% CAGR. Now, how do I answer myself, right? Saying that, hey, the index, the efficient frontier should make between 12 and 15, but there is this fund which seems to be making higher. How should I think about that, Pratik?
Yeah, so I think when you're evaluating performance of mutual funds, I think the biggest mistake that most investors make is to look at the highest performing fund. I think there's this huge habit of, I mean, including me, obviously, evaluating performance, the first thing you see is how is the fund performed. And I think it's very important for investors to look at slightly more longer term performance. What inevitably ends up happening, in fact, in my experience, in investing is that the top performers today end up becoming bottom performers tomorrow. So I think you really have to look at funds that are very consistent, and I think invest in those sort of funds, because if you look at top performing funds, you'll end up buying like a sector fund or a thematic fund, which again is like basically playing like the short term growth that has happened in that sector theme. So I do believe that yes, I think you I mean, as humans, we are obviously wired to overachieve, to over get, and I think it's important to have a healthy balance of active and passive. So most investors, so the theory behind how most advisors that I work with do is that they have a core and satellite portfolio. What that means is that they have a core portfolio where it's a part of your portfolio that does not change for 10, 15 years. So you have the same funds, and that could be an index fund where you can have that index funds in your portfolio for a long time because there's no underperformance. And then obviously, if investors feel that they are able to pick the right mutual fund, then maybe they can lose the satellite part of their portfolio to make 3 to 5 year bets. So I think that's how I maybe structure the portfolio in that way, is have a combination. I think which which uh, which I think is healthy, because then you're having a mix of both strategies, and you feel like you have something which will do well, but also you have that part of your portfolio where you feel that you'll be able to outperform or overachieve your expectations. So, but yes, I think definitely, I think performance should not be the only criteria when choosing a mutual fund.
Great answer. So, Pratik, till now, the two questions or the objections were from an aggressive investor, presumably a young investor. Now, I'm going to switch gears, right, and ask a question from an older conservative investor. So, this older conservative investor, I've been saying, don't keep your money in fixed deposits. It's not keeping up with inflation post tax. Go for an index fund. And the data point I've been using is that if you look at any rolling 3 year window in the last 15 years, the index has been positive 90% of the time, right? But the counterpoint that comes to me is that there have been 90 occasions, 90 days in the last 15 years, right, where the index has lost 3% a day. How do you answer a older conservative investor as to how they should be thinking about index fund when their entire thought process is about capital preservation?
That's a very good question. So I think when it comes to index funds or equity in general, I think one of the most important things which people end up missing out when they start investing is to know what the risk profile is. I think the first things in investing that and where I would recommend everyone to sort of do is, what is your risk profile? What is your appetite towards short-term drawdowns? If you just track the Sensex or the Nifty over the last 40 years or 25, 30 years, you'll see it's a straight line. But in the middle, anything can happen. And I think your success in investing is your ability to withstand the volatility or the short-term drawdowns that happen in your sort of investing life. And I think if an older investor is not able to stand the volatility, or is not able to take the volatility of the short-term drawdown of say 3% a day, then it does not make sense for that investor to invest in a portfolio which is 100% equity. I think investors should, instead of looking at their returns from a fund specific view, should look at it from a portfolio view. I think what investors should do is, if they're not okay with 3% returns, and if they're okay with say 1%, then maybe it makes sense to have a 60% of your portfolio in fixed income and maybe 40 in equity, and have the whole thing see in conjunction. So then you'll at least see that your portfolio is a lot more stable, as opposed to just looking at one fund. So that's one way of doing it. The second way of doing it is to own multiple asset classes. What we've seen is that investors that the problem with equity is that if you hold three different type of equity funds, say large cap, mid cap, small cap, you feel like you're diversified, but actually in reality there's not a lot of diversification. When the market falls, regardless if you have a large cap fund or a mid cap fund or a small cap fund, everything falls together. So the one way to counteract this is to have your money in different baskets. Don't have your eggs in one basket. So I think and I think within the investment universe, it's very good to have your money spread across fixed income, equity, gold, international equity, say real estate. And when you have these 4 or 5 asset classes in your portfolio, you're basically protecting the negative shocks, because never very very rarely will you have all asset classes going down together. when equity does badly, you'll see that maybe gold does well, or fixed income protects your portfolio. So I think having less proportion of money in equity, number one, and second is by spreading your money over different asset classes, you're actually doing wealth creation. You're creating wealth. You are beating inflation. It's better than FD, but you're also sort of minimizing the shocks of your portfolio, which is very important for someone who's obviously much older, who's more conservative and all of that.
Yeah, you made a great point on diversification. I use a technique, for example, in a week like what has happened this week, right? Which is simply you can't take a 3% drop in a day, so just don't check, right? And I'm only half joking because we're doing this for the long run, right? So it really is nothing we can do about what happened 90 times in the last 15 years, which was 3% a day. But like I said, since Jan 1st, 2000, it's been a 12% CAGR over 23 years. I'm going to shift gears a little bit, Pratik, given we have limited time. So, everyone and I go in for a Sensex 35, a Nifty 50. That's how the index is built up. But there are other variants of an index, like a 100, equal weighted. Tell us what are the two most popular variants after the Sensex fund and the Nifty Classic fund?
Yeah, so it's a very good point. So when most people think about index or passive, they think about Nifty and Sensex. Those are the default sort of two things they think about. But actually, index is across asset classes. So you can find index funds that track fixed income. You have index funds that track gold and silver. You have index funds that track international equities like Nasdaq and S&P 500, and you also have indexes in different categories. So you have a mid cap index fund, you have a small cap index fund, you have a Nifty 500 that captures all of India in one fund. You also have sector based index funds and ETFs, where if you just want to play the banking sector, or if you just want to play consumer, or some theme, you also have options for that. So say 5 years ago there were no options. Today, the biggest complaint I get from investors is there's too many options. I think we ourselves, at least Motilal Oswal AMC, so we have about 28, 30 funds. So yes, options are a lot. I think for investors who are looking at index funds as a category, they could look at, I think Nifty and Sensex is a very good broad indicator for Indian equity. My bias against Nifty and Sensex is that it's too narrow. When the Nifty was launched in 95, you had 50 large cap stocks. Today you have 100. 10 years from now, you'll have 500 sort of large cap stocks. So I think you want to play the entire basket as opposed to paying a narrow basket. But I do believe that investors looking at index funds should definitely look at, say, commodity index funds, should look at international index funds like a Nasdaq or S&P. Those are very popular, and I think a lot of investors have sort of used them for diversification and sort of portfolio management. Also, someone who's looking at who's slightly more risk-taking ability, who wants to take, say, small and mid-cap risk, but does not want to choose a specific fund, can look at a mid-cap index fund or a sort of small cap index fund. So these are the sort of popular ones. You talked about equal weight also. So there is also this category called smart beta, which I think is slightly more complex. Basically, the so the whole point about having an index fund is to match the returns of the benchmark. So if you invest in a Nifty 50 fund, you wanna and you invest in a Nifty 50 index fund, the idea is to replicate those returns. So the whole premise about smart beta funds is to outperform the Nifty. So it has the best of both worlds. You wanna get the low cost nature of an index fund while having the outperformance of an actively managed fund. Unfortunately, it's not as easy as it sounds. I think smart beta funds or factor funds, whatever you may call it, have bouts of outperformance and underperformance. So investors who are looking at this category, should do their research and should sort of know that it's not funds that are consistently outperforming all the time. But yeah, so there are equally weighted funds. You have momentum funds. You have quality tilted funds. You have low volatility funds. So I think these are all sort of sub strategy funds, which are getting popular. But I would say that people are still looking at I think if you look at most of the demand, it's coming from the simplest of products, like the Nifty or the Sensex or the Nifty 500. So I think this is where the market is currently.
Got it. And tell me, I've been looking around for this. You offer a Nifty 500 option?
Yes, we do. So I think Nifty 500 is like honestly one of my favorite funds. If someone asks me which is the one fund you recommend, I'm like, straight answer, Nifty 500. I think it captures 95% of the Indian market in one fund. And I think it's similar to what you would have in the US, which is the S&P 500. So I think it's a very broad-based fund. It covers all of India, and I think it's the least biased fund as well. So it's diversified across sectors, sizes. So I think that's a fund which I think we really recommend investors who are looking at investing in an index fund.
Right. So, Pratik, in a short conversation, we've gone reasonably deep in talking about index, right? But we've not had time, and we will not have time to talk about ETFs on this show. Uh, Obviously, ETFs have their differences, have their advantages, have their disadvantages. It's bought and sold like a share. You don't have to wait till the end of the day to set the price and so on and so forth. But for a common investor who's saving for the long term, right? Let's say for a child or for a house, if I've understood this much about index, right? Uh, what should I know about ETFs, or should I go deep into ETFs also? What would you recommend?
So, I think there is absolutely no difference between an index fund and an ETF apart from the structure of the fund. So, if you buy a Nifty 50 ETF versus a Nifty 50 index fund, your return is going to be pretty much the same. So, I think it really depends on what the customer prefers. An ETF is basically an index fund which is listed on the exchange. We used to have this quote. Acts like a fund but trades like a share. So it's basically an ETF is an index fund where so when you buy a mutual fund, you will basically get the end of day value as your investment value, which is called the NAV, the net asset value. So basically, you have only have once in a day that you can invest in an index fund, whereas in an ETF, you can actually buy an ETF in the morning and sell it in the evening. So I think that flexibility, if investors want that flexibility of trying to select the exact price, or they're looking to trade, then ETFs make a lot of sense. But someone who's looking at just simply investing, then I think mutual funds offer a lot more simplicity than ETFs. So even in fact, even I was talking to the survey about the survey. So we did a survey behind what investors sort of prefer, and I think majority of investors, I think approximately 65% plus, preferred index funds over ETFs because of how simple they are in terms of setting up your SIPs or even buying and selling. So I think yes, both are equally good. I really push investors to go for what their preference is in terms of, do they prefer buying it from the exchange versus buying it from the mutual fund directly. It really depends on their sort of ways.
Got it. So, Pratik, this has been a fascinating discussion, right? You are both, someone who looks at this intellectually, but also from a practice and a business perspective. My last question, given we're out of time, is Motilal Oswal also has a fund now looking at the private equity opportunity, one of the larger funds in the country. Now, we've discussed everything about index, right? For that investor, should they know anything, or should they be thinking about this private equity fund?
Yeah, so so there is obviously, when you look at mutual funds, you're specifically looking at public equities. So equities listed on the exchange, whereas private equity is obviously buying private companies. So obviously, because you're buying private companies, there is something called a risk premium that or your essentially your expectation tends to be much higher because you have liquidity risk. You're not able to sell that stock, buy and sell it instantly. So I think when it comes to private equity, I do believe that it's a slightly more sophisticated product. It's primarily an HNI and institution product in India, and obviously the entry barrier is quite high. So you have to shell out a check of 1 CR and above. Yes, we have a very successful private equity business. We do real estate as well as growth investing, where we manage about $2 billion. But I think that's something which ideally should not be compared to the public equities business. I think both are, I would say, different. The underlying companies might be the same, but you're basically buying companies at very different growth stages. One is obviously when a company is expanding, needs private capital to sort of extend the business, whereas the other one is more when a company is sort of reached a stage where they want to list and sort of becoming a public company. So I do believe that yes, I think private equity is an excellent vehicle for value creation. But you have to be again very careful about which private equity fund to invest in, and also you have to have a very long-term horizon. Most private equity funds tend to have a 10-year plus horizon. So when you are looking at this asset class, you have to have, a very slightly longer horizon than what you would expect in a public equities, say a passive fund, index funds, and ETF. But yes, you should also make sort of expect higher returns because of the sort of illiquid nature of this category.
Great, Pratik. I told you before we started, time would fly. So we are above time right now. But I've really enjoyed this discussion, and this is a very very important topic. You spoke very candidly. You obviously have a wealth of knowledge, given that you're managing valuable investor money in the category. Thank you so much for sparing your time. Thank you for sharing your insights. And I learned a lot. I hope everyone who's listening in and will listen in also, right, starts investing in index funds. Thank you, Pratik.
Thanks for having me, Adil, and thanks Bank Bazaar for also organizing this. Looking forward for the next one.
Thank you. Bye.
Bye.
Bye, everyone.